I think that the main issue, of course, is oil prices. We know that oil prices went down dramatically. We see it as a black swan event, something that you cannot predict. It happened in the past, it will happen in the future. Running a business is not about predicting those black swans, but rather positioning your business to deal with it. So I suggest that oil prices probably will remain relatively low because the Saudis, Saudi Arabia, OPEC, they're not playing the same role that they did before. Basically, they are not a swing producer anymore. They are not the price managers that they used to. This means that oil prices will not rest. It means that oil prices will remain volatile over the next year or so. And this means that even if they go up, we are not sure how long they will stay up, and that will impact the decision-making process in Alberta and, of course, shale oil in the U.S. So it might go up, but the volatility level will keep this industry vulnerable. This, of course, has major implications. Lower oil prices are still positive for places like China, the Eurozone, even the U.S. In Canada, of course, the main damage is Alberta, but for the rest of the economy, it's actually positive. For BC, for example, it's equivalent to roughly 9% tax cut given the decline in gasoline prices. So overall, I suggest that when you look at oil prices, yes, the main damage is Alberta, Saskatchewan, but some areas, including British Columbia, it is a pure positive, not a negative. To me, this means that BC actually will lead economic growth in Canada in 2015 and 2016, taking over Alberta. Given the decline in oil prices, the Bank of Canada decided to cut interest rates in January as an insurance policy. The Fed in the U.S. is still debating to what extent they will start raising interest rates, maybe in June or September. They really don't know at this point. Depends on where the economy is going. The main issue, of course, is not just the timing. Even more important is the trajectory of the increase, how significant it will be. I believe that the overall increase is going to be very gradual. They will move, let's say, September, but then they will rest a little bit. They will move again, let's say, in December. So it will be a very slow process, and the surprise will be how little it will take in terms of higher interest rates to basically limit any inflationary pressure. To me, this means that interest rates will peak at a much lower level than in previous cycles. That's very important. In Canada, we have a different story in which the Bank of Canada would like to keep the dollar relatively low. This means that the Bank of Canada might even cut again, and if not, they will start moving or raising interest rates much later. They will wait for the Fed and go very, very slowly. This means that interest rates in North America will remain relatively low for a long period of time, well into 2016. Well, there is no question about the fact that lower interest rates will keep the housing market going and rising. This market hasn't been tested yet. The test eventually will be higher interest rates, and therefore it's so important to see how we position ourselves to deal with this test. The rate at which Canadians are assuming debt has been slowing down over the past 2 or 3 years. In fact, debt now is rising almost at the slowest rate in any non-recessionary period over the past 40 years. So clearly we're not taking advantage of low interest rates to accelerate activity in terms of borrowing, and that's a good thing. In fact, in many ways, Canadians deserve credit for not taking credit, and that's, I think, something that we have to take into account when it comes to the BC market. Yes, the market is sensitive to higher interest rates. Those higher interest rates are not coming. There's significant supply issues. We don't have enough supply in the province and definitely in the city of Vancouver, and that's why prices are elevated. We have young people struggling to buy houses. Therefore, the condo market is basically introducing a sense of stability into the system. It's actually a stabilizing force as opposed to a destabilizing force because there is an element of affordability there. I think that the rental market will actually go even higher than it is now. There is a huge amount of demand for rental properties because young people cannot buy. There is a lot of interest by foreign investors. This market will continue to rise. What we see more and more is a shift from the condo market as the main supplier of rental activity into a purpose-built activity. And I think that's something that we will start seeing over the next 5 years. So the rental market will be strong. The composition might change a little bit.